Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. I found an article from Seeking Alpha that was posted today, so it's fresh off the press, right? Fresh off the press, talking about how gold could be headed substantially higher from here. And when we're going to be talking about high gold prices, we have to talk about high silver prices as well, because more than likely silver is going to be outperforming gold even if they both are in a bull run. So let's go over the summary and then let's dive into this article. Before we start though, make sure to smash that like button. Let's see if this video can get 150 likes. Each and every one of you, hit the like button. It supports the channel tremendously. It helps get the videos out, and it helps bring people into the world of precious metals as well. So anyways, gold is up substantially over the last year, but we're still very likely in the early stages of a bull run. So just because things might be starting to sprout, we still have a long way to go. The Fed is expanding the monetary base, a very constructive development for gold. The U.S.'s incredible debt burden is also a favorable catalyst. Low interest rates and amplified inflation are also constructive factors for gold. I expect substantially higher gold prices moving forwards. And we know that Seeking Alpha is also very bullish on silver. A lot of people are looking from the 3 to 6 month range on silver to hit that $18, $19 range, which is definitely possible. We could see prices change from the snap of a finger within a couple dollars within a couple days. You know, silver could be up $16, $17 within a week from now. So the 3 to 6 month time frame is very possible, and more than likely, especially with the pandemic still spreading, and we even might have a round 2 of the pandemic as things open up, as stores, businesses open up tomorrow. So anyways, gold has performed quite well in recent years. In fact, the yellow metal is up around 35% over the past year alone, with the S&P 500 and other major averages that are down by 15% or more since their all-time highs were reached earlier in the year. So gold is still standing its ground. So here's the 1-year chart on gold actually. It's very bullish. However, despite gold's stellar performance, the precious metal is still very likely in the early stages of this remarkable bull cycle or bull market cycle. Unprecedented monetary expansion, immense debt, amplified inflation, extremely low interest rates, and other constructive factors are likely to send gold prices substantially higher over the next 2 to 3 years. And when they say the next 2 to 3 years, it reminds me of what the 2008 credit crisis, which led to $50 silver in 2011, which took about 2 to 3 years, and we're right in the mix of things in the beginning stages of that, which could be in the next 2 to 3 years, leading to $50 silver again. So Fed's unprecedented stimulus. The Federal Reserve is in the process of creating an unprecedented amount of new money to deal with the fallout from this pandemic or this epidemic. The Fed has announced several multi-trillion-dollar monetary programs designed to provide massive liquidity to markets to prevent the economy from collapsing. Coupled with Fed stimulus, the government is coming out with a bailout program to inject capital into various segments of the U.S. economy as well. So they're just pumping more dollars into the system that they really don't have. And it's really going to expose the truth. It's going to be exposing how broke we really are. There is only one problem. The U.S. government doesn't have any money, which I was just talking about. So all these trillions are coming from the Fed. The Fed simply can't digitalize all the dollars it needs to buy. Treasuries, corporate bonds, junk bonds, or just about any other kind of debt it wants to inject immense capital into the financial system. The problem is that the kind of monetary policy is bound to significantly dilute the U.S. monetary base. We can already see that the monetary base has increased to around 3.9 trillion and is floating about on par with prior all-time highs. However, the Fed's printing presses are just getting started, and the eventual post-CV monetary base could be sitting around 10 trillion or more. Now, we know that the U.S. dollar is no longer officially backed by gold, right? The U.S. dollar is backed by nothing. So what is that going to entail for gold and silver? That shows what true money really is. In fact, it is not. If it's not backed, it is not backed by anything tangible anymore. Our money is backed by faith, by hope. And if people lose hope in the dollar, then the dollar's value is deflated because there's nothing actually backing it. Nevertheless, if we trace back to the monetary base, we can see that despite the decoupling from the gold standard in 1971, it correlates extremely close with the price of gold. From 1971 to now, the monetary base has increased from around 80 billion to roughly 3.9 trillion, an increase of around 4,775%. During the same time frame, gold has surged from about $36 all the way up to $1,720, a percentage increase of roughly 4,600%. So, we can see that despite losing its official correlation, the two, gold price and monetary base expansion, are very much correlated to this day. So what will happen next? We know that the monetary expansion is just getting started, and while the monetary base is around 3.9 trillion today, it is likely to climb substantially higher as the Fed continues to monetize debt and inject liquidity into various areas of the market. Currently, the monetary base is around 3.9 trillion, but a couple of years down the line, it could be 10 trillion, possibly even higher. We know right now we're $24 trillion in debt if you go to usdebtclock.org. This monetary expansion means that the substantial higher prices for gold are going forwards as well. If we use 3.9 trillion to 10 trillion formula, to $10 trillion formula, we see that this is about a 156% increase. Thus, if we apply the same percentage to gold, we could be looking at gold prices of around $4,400, possibly within the next 2 to 3 years. Also, it appears that the price of gold is currently slightly lagging monetary base expansion. So, if we use the formula of $80 billion monetary base in 1971 relative to possibly $10 trillion monetary base going forward, that gives us a percentage of roughly 12,400%. If we apply the same percentage increase to $36.56 price of gold in 1971, we arrive at $4,570. Thus, either calculation with us provides a gold price target of around $4,500, which could be achieved over the next 2 to 3 years. So wow, $5,000 gold. Is that possible? While we're discussing gold, it seems appropriate to discuss the U.S.'s unbelievable debt burden as well. As I look at the debt clock right now, I see the U.S.'s national debt's a staggering $24.7 trillion, which I was just explaining earlier. Federal spending is utterly out of control, $6.67 trillion relative to $3.56 trillion in tax revenue. This leaves us with an actual federal budget deficit, a gap of over $3 trillion. Far higher than any time throughout history. Not surprisingly, the U.S. now sports one of the highest debt to GDP burdens in the world. The U.S. federal debt to GDP is now at 115%. So the takeaway on the debt is clear. It's a huge problem. First, we see that the U.S. is spending far more than it's taking in revenues. $3 trillion in deficits are not sustainable without grave side effects within the U.S. economy. Granted, part of the monstrous deficit is due to the CV breakout. Even without its U.S. is used up running up trillions of dollars plus deficits almost regularly. So how to deal with all this debt? Is there a solution? Well, there are no real silver bullets, just like there aren't ready for the virus. Debt is just something we're going to have to deal with, and likely to be very hard and painful. First, the huge deficit may require tax hikes to bring the budget back closer to the balance. Second, we're probably never going to see the benchmark rate go above zero in the future, as it would mean higher rates, mean higher services payments on the debt. Furthermore, the Fed likely will continue the dose of QE, which is quantitative easing, on a perpetual basis to create artificial demand for the U.S. Treasuries so that rates can remain extremely low indefinitely. Also, the U.S. is not likely to produce any meaningful economic growth in the future due to the crushing debt. So, we're at a very interesting place right now, right? We're at a very interesting place, and the debt is just, we're going to have to deal with it. Now, what does this mean for our monetary system? Who knows? Only time will tell. So let's look at a view at the gold to silver ratio. On Gauge, I like to look at what the assessing life cycle is, the gold bull market cycle is to the silver ratio. Throughout recent decades, we would typically see this gauge top at the low mid 80s. This would illustrate that you could buy roughly 80 ounces of silver to 1 ounce of gold. This would also typically mark a bottom in the gold market. Then towards the end of the bull market run, we would see a low of around 40 or 50 in the ratio, and this would normally even mark the top of the gold market. The reason why we see a top of the ratio contract is because silver typically outperforms gold mid to later stages in the precious metals bull market cycle. But, however, this time we did not see a top in the gold to silver ratio emblematic 80-90 level. Instead, it blew past 100 and it's all the way at around 125. This is unprecedented and it illustrates a huge disconnect in the gold to silver ratio. It likely implies that we are still in the early stages of a gold bull market cycle that could prove to be more robust than we've ever seen before. So, there's definitely a lot of information, and I definitely like this article a lot. I really liked how they were calculating, the dollar when it was $37 gold or $36 gold. It could be up to $4,500 gold, which is definitely possible looking at the same monetary policies and the expansion, how they did the formula with the calculation, and it's definitely possible, right? It's and like it even says, thus either calculation we provide uses us with or provides us with plausible gold price target around 4,500, which could be achieved over the next 2 to 3 years. So we could be seeing a lot of profits, but also a lot of expansion in the precious metals world, especially what that would do for demand and also the supply. So anyways, I'm curious what you thought about this article. If you thought this video was educational, informational, or just entertaining, make sure to smash that like button. What do you think about high silver prices and high gold prices to these extents? I'm curious. I definitely think silver could be $200, gold could be $5,000. It's definitely possible. Anyways, if you did enjoy this video, make sure to smash the like button. Let's see if this video can get 150 likes. Everyone, go like the video now. Appreciate it so much. Thanks for tuning in. This was Silver Slayer. I'll see you guys soon. Peace.